is Takaful and Risk Management Product and Process. For our forum today, we have 3 panel, which are Ms. Wan Nur Adila as panel 1, Ms. Fatimah Shahira as panel 2, and lastly, Ms. Halima as panel 3. It's pleasure for me, Nur Akidah Najihah binti Muhammad Rafi, with metric number 280593 as a moderator for today. For me, Takaful is a scheme that is based on the pillar of brotherhood, solidarity, and mutual assistance. Participants of the scheme agree to provide mutual financial aid among each other. The term Takaful, kafalah, which means responsibility, guarantee, amenability, or suretyship, literally is joint guarantee, share responsibility, share guarantee, collective insurance, and mutual undertaking. On the other hand, Takaful is a system whereby participants contribute regularly to a common fund and intend to jointly guarantee each other. There are 3 main types of Takaful, which is Mudarabah, Murabahah, and Musyarakah. First, Mudarabah is one of the oldest concepts in Islamic finance and is based on profit sharing. This type of Takaful is practiced widely in the Asian Pacific region. The company's management is paid from the profit and the company make and share in the surplus and losses. The ratio of the profit sharing is pre-agreed on the basis of the company's performance. Second, Mudarabah, also referred to as cost plus financing, in an Islamic financing structure in which the seller and buyer agree to cost and markup of an asset. The markup takes place of interest, which is illegal in Islamic law. As such, Murabahah is not an interest-bearing loan, card riba, but is acceptable form of credit sale under Islamic law. As if as rent-to-own arrangement, the purchaser does not become the true owner until the loan is fully paid. Next is Musyarakah, is an Islamic contract where 2 or more parties contribute capital to the business because all the parties to the arrangement contribute capital to the business. The partner will share any profit or loss arising from the business or arrangement. The profit sharing is based on the agreed allocation between the partner as determined at the contract inception. On the other hand, partners share any loss based on the proportion of their capital contribution. Okay, next we move to the comparison between Takaful and conventional insurance. In contract type, Takaful is a combination of a tabarruk contract and an agency or profit sharing contract, while insurance is a contract of exchange, sales, and purchase between the insurers and the insured. In obligation of the participant policy holder, Takaful have participate are duty bound to make contribution to a scheme and are expected to mutually share the surplus, while insurance policy holder are duty bound to pay premium to the insurer. In obligation of the operator or insurer, the Takaful operator acts as the administrator of the Takaful fund and pay benefit from it. If there is any insufficiency in the fund, the Takaful operator must provide interest-free loan to rectify the deficiency, while the insurer is liable to pay the benefit as promised from the insurance fund and or the shareholder funds. In return of the operator or insurer, the Takaful operator earn of return for rendering of service or managing the Takaful program or from the Mudarabah profit sharing scheme as Mudarib, while the insurance company make a profit when there is an underwriting surplus. In counter value, Takaful have the counter value. EY is the effort or undertaking of risk, while insurance have no clear valid counter value. The source of profit from anticipating, hoping that the uncertain future will be in their favor, that total premium will exceed total claims. And the last is the identification component. Takaful is the identification component is based on mutual contribution and reciprocal donation, tabarruk, while insurance is in the indemnification component is a commercial relationship between insurance company and the insured. Okay, last but not least, the Takaful contract applies mutual assistance among member insurance. In other hand, Takaful uses the principle of resharing, whereas in conventional insurance is a risk transfer the occur from the client of insurance company. Takaful fund management to avoid the forbidden element to usury interest, darar, uncertainty of fund, and my say gambling. From my experience, I suggest to all of you to take the Takaful then insurance before something undesirable happen. Okay, so without any further delay, let's proceed with the opinion of our panel one for today. Miss Adila, will you mind giving us your opinion and understanding about the life and general Takaful?
First and foremost, I would like to say thank you to our pretty moderator, Miss Akida. Before we proceed to the question, let me introduce myself. My name is Wano Adila binti Wan Mohta Yusof. Okay, we can proceed to the first question, which is general takaful. General takaful offer all kind non-life risk coverage and is divided into a few classes, which are property takaful, marine takaful, motor takaful, and also miscellaneous takaful. Next is life takaful. Life takaful is a protection to yourself or your family if something unpredictable happens, such as death, sickness, or accidents. Example for life takaful such as hibah, medical checkup, and education. Hibah takaful refer to a gift given by a person to another person freely while she or he still living. This means that if you die as a takaful contributor, your nominee will get full reimbursement for the benefit of the takaful plan which you are participate. I really suggest to all people to take hibah takaful for their protection because we never know what can happen in the future. Hibah takaful have a lot of advantage such as income replacement, debt settlement, absolute receipt and hassle-free process, and last but not least is education fund. From our previous assignment, we can see individual with payslip Miss Wano Rashida take a hibah takaful, and the coverage from hibah takaful can help her family to cover all the monthly expenses. Okay, I hope you guys clear with my explanation, and I hope you guys can consider with my suggestion to take any takaful product or hibah takaful just for your protection. Thank you, and we give back to our pretty moderator, Miss Akida.
Thank you, Miss Adila, for your explanation. Okay, let's proceed with our panel to Miss Shahira. From our panel one, we already see and know their understanding. How about you, Miss Shahira? Can you elaborate your understanding on risk management at an individual level?
Thank you to our moderator, Miss Akida. Assalamualaikum warahmatullahi wabarakatuh, and very good morning to all the panelists and the audience. I'm so glad to be one of the panel here. So, my name is Fatima Shahira binti Muhammad Lukman, and my metric number is 280715. Now, I will explain about risk management at individual level. In general, risk management for individuals is the process of identifying risks to the value of our household asset and developing an appropriate strategy for dealing with these risks. The risk management strategy provides a framework that allows the household to decide when to avoid, reduce, and transfer or self-insure those risks. Furthermore, risk management for individuals is a key element of life cycle finance, which recognizes that as investors age, the fundamental nature of their total risk involved, as do the risk that they face. Life cycle finance is concerned with helping investors achieve their goals, including an adequate retirement income, by taking a holistic view of the individual financial situation as he or she moves through life. Individuals are exposed to a range of risks over their life. They may become disabled, suffer a prolonged illness, die prematurely, or outlive their results. In addition, From an investment perspective, the asset of individuals could decline in value or provide an inadequate return in relation to financial needs and aspirations. All of these risks have two things in common, which are typically random, and they can result in financial hardship without an appropriate risk management strategy. So we can conclude that risk management for individuals is distinct from risk management for a corporation, given the distinctive characteristics of household, which include the finance and unknown lifespan of individuals, the frequent preference for stable spending among individuals, and the desire to pass on wealth to heirs. To protect against unexpected financial hardship, risks must be identified, market and no-market solution considered, and a plan developed and implemented. A well-constructed plan for risk management, it will involve the selection of financial products and investment strategy that fit an individual financial goals and mitigate the risk of shortfalls. I think that's all my explanation today. Thank you for your cooperation.
Thank you, Ms. Shahira, for your explanation. After we hear all the explanation from the panel, we will move to our next panel and last panel. Okay, Ms. Halima, as we learn from Islamic view, can you give some idea about Islamic risk management system and Takaful industry?
Thank you for the question, Ms. Moderator. Next, I will state some ideas about Islamic risk management system and the Takaful industry. In essence, the Islamic risk management system in the Takaful industry is entrusted to parties with specialist expertise in the field of Sharia, such as the Sharia Committed and the Takaful company. However, non-Sharia staff other than Sharia Committed and the Takaful company also play an important role in managing any Sharia risk exposure in the operation of the Takaful company. Every employer of the Takaful company is responsible for ensuring Sharia compliance in the operation of Islamic financial institution. Thus, in a study, it was found that non-Sharia staff, especially at the front counter, were the first to identify when there was exposure to Sharia risk in the operation of the Takaful company. Therefore, there will be staff who act to identify and screen in case of risk exposure in the Takaful contract application. In addition, with the increase in the Muslim population today, the Islamic financial industry, including the Takaful industry, is seen to have a good market for a long time, coupled with the low insurance ownership rate among Muslims. However, the high potential in the Takaful market requires efficiency in Takaful operation, including related to risk management process in Takaful company operation. As we all know, risk management is a mechanism or process that manages a risk that may occur, including in the industry. There are various types of risks that need to be managed in the Takaful industry, including operational risk, market risk, and legal risk. Therefore, each employer has an important role to play in managing Sharia risk, especially in ensuring that the overall operation of the Takaful company function as it should. For example, if the Sharia risk exposure involving the Takaful company does not fulfill the Takaful contract, then the Takaful company must immediately fulfill the ability of the contract within the agreed period. At the same time, the function and responsibility of non-Sharia staff are under emphasis in the process of managing risk exposures. Most of the risk management roles and responsibility are solely the responsibility of the internal Sharia committed. Therefore, non-Sharia staff need to be provided with the training and knowledge related to Sharia compliance required to ensure the Sharia compliance of the Takaful company's operation. Finally, the function and responsibility of non-Sharia staff, especially Takaful companies, need to be improved and strengthened to increase the confidence of existing shareholders and stakeholders and attract investors in the future. I think that's all from me. I leave the rest to the moderator. Thank you.
Thank you, Ms. Halima. That was our last question for our forum for today. Thank you to all of our panel for their time and explanation. Before we end our forum session, let me make some conclusion. Both Takaful and conventional insurance provide protection in the event of unforeseen event, and contribution must be made to start The coverage. Insurance is the transfer of risk by an individual or an organization, while Takaful provides protection based on Sharia principle by contributing the sum of money to a common Takaful fund in the form of contribution, which is tabarut. You will undertake and contract akad to become one of the participants by agreeing to mutually help each other should any of the participants suffer a defined loss. And the last is risk management for individual is a key element of life scale finance, which recognize that an investor is the fundamental nature of their total wealth involved and do the risk that they face, and also every employee and the Takaful company is responsible for ensuring Sharia compliance in the operation of Islamic financial institution. Thank you and see you later.